It is September 2008. Lehman Brothers has just collapsed. The stock market is in freefall. Your portfolio is down 30% in a matter of weeks. Every headline screams sell everything. And in that exact moment, Warren Buffett picks up the phone and invests $5 billion into Goldman Sachs. The question is not whether he was right. The question is whether you could have done the same thing. Welcome back to the Daily Investor. Today, we are going to take a test together. Not a test of your financial knowledge, not a test of your IQ, but a test of something far more important. Buffett himself has said, and I quote, "The most important quality for an investor is temperament, not intellect." After 50 years in the markets, I can tell you with absolute certainty that he is right. Brilliant people blow up their portfolios every single year, not because they lack knowledge, but because they lack temperament. Today, I am going to walk you through the 4 tests that separate successful value investors from everyone else. And I want you to be honest with yourself about where you stand. The first and most fundamental test is patience. And I do not mean waiting a few months. I mean years. Sometimes a decade. Let me give you a real example. In 1988, Warren Buffett began buying shares of Coca-Cola. He invested roughly $1.02 billion over 2 years, accumulating 400 million shares. At the time, plenty of analysts said he overpaid. The stock had already run up significantly. But Buffett saw something others did not, an unmatched global brand with pricing power that would compound for decades. Fast forward to today. That $1.02 billion investment is worth over $25 billion, and Berkshire Hathaway collects more than $700 million a year in dividends alone. That is a 56% annual dividend yield on his original cost basis. But here is the part nobody talks about. Between 1998 and 2003, Coca-Cola stock went essentially nowhere. 5 years of flat returns. Most investors would have sold and moved on to something more exciting. Buffett held. He is still holding. The patience test is simple. Can you buy a great business at a fair price and then do absolutely nothing for years, even when it looks like the market has forgotten about your stock? The Dalbar Research Group has studied this for decades. Their data consistently shows that the average equity fund investor earned roughly 6.8% annualized over the 30 years ending 2023, while the S&P 500 returned approximately 10.2% over the same period. That gap is staggering. $100,000 turns into $1.8 million if you simply hold, versus $735,000 if you trade in and out like the average investor. More than $1 million lost, not to bad stock picks, but to impatience. Most people fail this test. The second test is whether you can act when everyone around you is panicking. This is not just about staying calm. It is about actively buying when your gut is screaming at you to sell. Go back to the fall of 2008. The S&P 500 peaked at 1,565 in October 2007. By March 2009, it had fallen to 676. A 57% collapse. Trillions of dollars in wealth gone. Banks were failing. People were losing their homes. During the absolute worst of it, Buffett wrote an op-ed in the New York Times on October 16, 2008 titled "Buy American. I Am." He was not just talking. In September 2008, he invested $5 billion in Goldman Sachs preferred stock at a 10% dividend. In October, he put $3 billion into General Electric on similar terms. People called him reckless. Some said he had lost his touch. His Goldman Sachs investment alone eventually generated over $3.7 billion in profit. But here is the test. In 1999, at the peak of the dot-com bubble, Buffett refused to buy technology stocks he did not understand. Barron's ran a cover in December 1999 essentially asking what was wrong with Warren Buffett. He looked foolish. The Nasdaq was up 86% that year. Berkshire Hathaway stock actually declined. And then the Nasdaq crashed 78% from March 2000 to October 2002, falling from 5,048 to 1,114. The Contrarian Test asks 2 questions at once. Can you refuse to join the crowd when everyone is getting rich? And can you step in and buy when everyone is running for the exits? Most people can do neither. Buffett did both. The third test might be the hardest. It is humility. The ability to admit what you do not know and stay within what Buffett calls your circle of competence. Here is a story that illustrates this perfectly. In the early 2000s, Buffett repeatedly said he did not understand technology businesses well enough to value them. For years, he sat across the table from Bill Gates at bridge games and still did not buy Microsoft. People mocked him for it. How could the greatest investor alive ignore the most successful company of a generation? But Buffett knew something crucial. It is not about maximizing every opportunity. It is about never making a catastrophic mistake. He has said, risk comes from not knowing what you are doing. By staying within his circle of competence, consumer brands, insurance, financials, railroads, he avoided every major blow-up that destroyed other legendary investors. Compare that to long-term capital management, the hedge fund run by Nobel Prize winners and PhD mathematicians in the late 1990s. They were arguably the smartest people on Wall Street. In 1998, their fund collapsed, losing $4.6 billion in less than 4 months. They leveraged their portfolio 25-1 on trades they believed were mathematically certain. The Federal Reserve had to coordinate a $3.6 billion bailout to prevent broader financial contagion. Genius failed because it lacked humility. The humility test asks, can you say I don't know and walk away from an opportunity, even when it looks like easy money? Can you admit a mistake early, take a small loss, and move on before it becomes a catastrophic one? Benjamin Graham wrote in The Intelligent Investor, the investor's chief problem, and even his worst enemy, is likely to be himself. That was true in 1949 when he wrote it. It is true today. The final test is one nobody talks about. Can you be bored? Value investing is, by design, boring. You analyze a business. You estimate its intrinsic value. You wait for the price to fall below that value with a margin of safety. You buy. And then you sit there. For years. Doing nothing. Charlie Munger described Berkshire Hathaway's strategy perfectly. He said, the big money is not in the buying or the selling, but in the waiting. And if you look at Berkshire's actual trading activity, this is exactly what you see. Buffett has held American Express since 1964. That is 62 years. He has held Coca-Cola since 1988. He has held Moody's since 2000. Meanwhile, the average holding period for stocks on the New York Stock Exchange has dropped from about 8 years in the 1960s to less than 6 months today. We have gone from investing to high-speed speculation. The boredom test is this: when your friends are trading options, chasing meme stocks, and posting screenshots of 200% gains, can you sit quietly with your portfolio of boring, wonderful businesses and do absolutely nothing? Because the data is overwhelmingly clear. The less you do, the better you perform. Here is the truth about value investing. The concepts are simple. Buy good businesses below their intrinsic value and hold them for a long time. A teenager can understand that. But the execution requires a temperament that most people never develop. Patience when nothing is happening. Courage when everything is falling apart. Humility to know your limits. And the discipline to be bored while everyone around you is chasing excitement. If you passed all 4 of these tests honestly, you have the raw material to be a successful value investor. If you struggled with 1 or 2, that is normal. Temperament is not something you are born with. It is something you build through practice and through understanding why it matters. This is educational content, not financial advice. Always do your own research and consult a qualified financial advisor. But I will say this: working on your temperament will do more for your portfolio than any stock tip ever could. I want to hear from you. Which of the 4 tests is hardest for you? Is it patience, contrarian thinking, humility, or boredom? Drop it in the comments. I read every single one, and I think you will be surprised how many people share the same struggle. If you found this helpful, subscribe to The Daily Investor. We put out a new video every single day to help you think like the greatest investors in history. Tomorrow, we are going to dive into how to actually calculate intrinsic value step by step, so make sure you do not miss it.